What's up everybody? Chris here from projectoption.com, and in today's video I am going to talk to you about why the percentage of profitable trades when you're analyzing a strategy does not mean anything by itself. Now, it's not completely worthless, but you need more information than just the percentage of profitable trades to really know whether a strategy is successful or a failure. Now, one of the appeals of options trading is that you can trade strategies that will have a high rate of success. Now, in some cases, you could have a strategy with a success rate of 90% or 95%, and that's especially true when you sell options and take profits at very small percentages of the profit potential. Now, in this video, we'll examine why success rates alone mean nothing. So let's start by looking at three hypothetical traders and their percentage of profitable trades over the past year. So we have trader A, trader B, and trader C. Now, trader A had a success rate of 37%, trader B had a success rate of 55%, and trader C had an astonishing success rate of 87%. Now, which of these three traders do you think was the most profitable over that year? Now, it might be easy to just assume that trader C, with a success rate of 87%, was the most profitable over the past year, but we actually have no idea which of the three traders had the best performance. And that's because we need to know two other pieces of information in addition to the percentage of profitable trades to really analyze each trader's performance. The two pieces of information that we need to know are the average profits and the average losses. So when the trader has a winning trade, what's the average profit? And when the trader has a losing trade, what is the average loss? Without those two pieces of information, the percentage of profitable trades means nothing, and it's just a percentage. So let's go back and look at the same table, but we're going to add the average profit and average loss per trade, and then we'll actually be able to determine which trader had the best performance. Now that we know the average profits and average losses of the trades, let's look at each trader's performance relative to the percentage of profitable trades and the average profits and losses. So trader A has an average profit of $100 per trade and an average loss of $200 per trade. Now, with a percentage of profitable trades of 37%, the expectancy is negative $89 per trade. So they're expected to lose about $90 over the long term based on their current strategy. Now, that expectancy is just the expected value formula, which is the average profit times the win rate minus the average loss times the loss rate. Now, there is a download link to a spreadsheet in the description that you can use to analyze your own strategies, but we'll get to that later. Now, we can see that trader B has an average profit of $100 and an average loss of $90, and with a success rate of 55%, the expectancy is $14.50 over the long term based on their current trading strategy. Now, lastly, trader C, with a percentage of profitable trades of 87% and an average profit of $50 and an average loss of $300, has a trade expectancy of $4.50. So despite having the highest win rate, trader C actually has 33% of the trade expectancy as trader B, and trader B has a success rate that's 32% lower. So with more information, we can actually see that trader B had the best performance despite having a middle of the road rate of success. So what does it all mean? Why am I bringing this topic up? Well, the point of bringing up this topic is to show you that just because a strategy has a low realized success rate, it doesn't mean it's a bad trade. Now, in the same vein, strategies with really high success rates are not necessarily good trades. So if you find a trading strategy that has a success rate of 94%, it doesn't actually mean that that strategy will be more profitable than a strategy that has a 70% success rate or even a 40% success rate. So you need to know the relationship between the percentage of winning trades, the average profits when they're winners, and the average losses when they're losers. The key is the outperformance of the required success rate that you need to break even given your average profits and average losses. So let's go through a couple examples to show you what that actually means. So as an example, let's say you are a long premium trader, which means you typically buy options. Now let's say your strategy is to buy an option and sell the option when its price doubles, which means you have a 100% return on the price you pay. Now if that doesn't happen, you'll let the option expire worthless. So to keep things simple, let's say you either hit a 100% return on the option's price, or you let the option expire worthless, in which case you have a 100% loss. Now, based on a 100% return or a 100% loss, you'll need a 50% success rate just to break even. Now, that comes from the 50% win rate times 100% return minus a 50% loss rate times a 100% loss comes out to $0. So, to have this strategy be profitable over time, you'll need to have a success rate greater than 50%. But that's not the only way you can get positive expectancy. To achieve positive expectancy, in addition to increasing your win rate through good entries or a good system, you can achieve positive expectancy by having losses smaller than 100% on average. Now, that's true if your success rate remains the same and your profits remain the same. So if you have a 50% success rate and 100% profits on average, if your losses are smaller than 100% on average, then your strategy will be profitable over time. Now, the third way to achieve positive expectancy is if your profits are greater than 100%, but you keep the same success rate and the same losses. So if you keep that 100% loss and the 50% success rate, if your average profits are greater than 50% or 100%, then that strategy will have profits over the long term. Now let's hop over to a short premium example. So an example of a short premium trade would be if you sell strangles. So let's say you sell strangles and you plan to take profits at 50% of the maximum profit or take losses when the credit doubles. So that would mean if you sell a strangle for $1, you're going to take it off when the price drops by 50% or gets to 50 cents, or you're going to take it off when the price increases by 100%. So if you sell it for $1, that would mean you would take it off for a loss when the price reached $2. Now, based on a 50% average profit or a 100% average loss, you'll need a 66.6% success rate to break even over time. And there's the expected value formula that shows you how you get to that number. So if you have this management strategy, there are a few ways you could get to positive expectancy. So there are 3 ways you can achieve positive expectancy based on these numbers. The first is if you have a higher than 66.6% success rate. So if you keep the average profits at 50% and your average losses are also 100%, if you have a success rate of 75%, then your strategy will be profitable over time because your success rate is exceeding what is required to break even. Now, the second way to achieve positive expectancy is if your average losses are smaller than 100%, while you keep the same 66% success rate and the same average profit of 50%. Now that's because if you had an average loss of 80%, for example, and you still had the 66% success rate and the 50% average profit, then that 66% success rate would actually be higher than what is required with a 50% average profit and an 80% average loss. Now, the last way you can achieve positive expectancy is if your profits on average are greater than 50% while you keep the same success rate of 66% and the same average loss of 100%. Now, the bottom line is that it's easy to be deceived by high or low success rates when analyzing trading strategies, but don't be fooled. The success rate does matter, but only in the context of the average profits and the average losses over time. Now, I know we went through a lot of math in this video, and that's why we decided to create a free tool for you, which is the strategy analysis spreadsheet. So you can download this spreadsheet with the link in the description, and I encourage you to do that and plug in the values. So you plug in the success rates, the average profits, and the average losses, and see how the numbers change when you change one of those inputs. I guarantee you it will help you understand the relationship between the success rates and the average profits and losses. And even cooler than that, if you have your own historical trade data, you can plug in your own real success rates, your average profits, and your average losses, and you can see how you're performing relative to the required break-even success rate. So that should overall be an awesome tool for you to use, and like I said, the link is in the description. Alright, so let's go ahead and quickly run through the concept checks to recap what we talked about in this video. First and foremost, option strategies can have extremely high or extremely low success rates, but the success rates alone do not mean anything. Now, what does matter is the combination of success rates, average profits, and average losses for various trading strategies. So when you analyze the three of those metrics together, you can get a much better understanding of how a certain trading strategy is performing. And lastly, starting from a baseline expectancy of 0, positive trade expectancy can be achieved through one of three ways. The first is by increasing the win rate and keeping profits and losses the same. The second way is to increase profits while keeping the losses and win rate the same. And the third way is to decrease the losses while keeping profits and win rate the same. So by changing one of those three inputs, by keeping the other two constant, you can achieve positive expectancy. Thanks so much for watching this video, everybody. I hope you enjoyed it. If you did and you found it informative, please give it a like, share it with your friends, and go ahead and subscribe to our YouTube channel so you can get all of our future options trading videos. And lastly, if you want to check out some more of our videos, go ahead and click on that playlist link on the right-hand side.